right now, U.S. Treasuries are handing out a risk-free 4.5% yield, which, I mean, by all conventional financial logic, an asset that pays you absolutely zero interest, like gold, should be an absolute free fall right now.
Oh, absolutely. I mean, institutional algorithms, they're programmed to chase yield.
Right.
So when they can get 4.5% guaranteed from the government, they dump the zero yield assets. That's just the baseline rule of the market.
But the thing is, gold isn't in free fall. It's, stubbornly holding this massive price floor. And the reason for that is, well, it's one of the most fascinating paradoxes in our modern financial system right now.
It really is.
You have the biggest institutions in the world quietly acting as this massive liquidity sponge, basically absorbing all the excess supply that retail investors are shedding.
Yeah, and the scale of that institutional absorption, it's completely unprecedented. It is short-circuiting the traditional models, honestly.
Right.
Well, when you have a fundamental macroeconomic setup that just screams sell, right? But the underlying physical asset refuses to break below a specific threshold, you're witnessing a real structural shift in global capital flows.
Which brings us to the core mystery of our evening news bulletin for today, June 22nd. Because while gold is managing to hold that structural floor, its traditional partner in crime, silver, is suddenly buckling.
Yeah, that was the big shock today.
Right. The classic synchronized routine of the precious metals market literally just fractured in real time today. So for this deep dive, we're going to unpack the mechanics behind this divergence, analyze the massive global forces that are actively dragging these metals down, and figure out how to position your portfolio when the biggest players in the market are making completely contradictory moves.
It's a lot to unpack, but it's crucial data.
Exactly. And hey, real quick, if you're utilizing these deep dives to stay ahead of institutional capital flows, hit that subscribe button and drop a like so we can keep bringing you the raw data and the mechanics behind it all.
So getting right into it, looking closely at the trading floor dynamic today really reveals the severity of this fracture.
Yeah, the tape was wild today.
It was. Gold spent the entire session locked in this brutally tight, highly volatile algorithmic battle.
Yeah.
It was bouncing between $4,170 and $4,210 an ounce.
Basically just a $50 window.
Right. And sellers have clearly established this algorithmic tripwire right at the 4,200 mark. So the moment the price ticks over that psychological threshold, sell programs instantly flood the market with paper contracts, just swatting the momentum straight back down.
Wow. And the sheer volume required to suppress the price at 3,200, that tells us this isn't just retail taking profits, right?
Not at all. No, it is a highly managed technical bounce, but the stark contrast is what happened with silver today.
Yeah, let's talk about silver.
Silver flashed a level of weakness that completely decoupled from gold's resilience. I mean, the timeline of the silver sell-off is the critical data point here.
Right, because it started out okay.
Exactly. During the overnight and early morning session, so between like 2 a.m. and 10 a.m., silver was actually holding a stable channel. It was between $66 and $66.80 an ounce.
Showing the exact same stubbornness as gold.
Precisely.
But then 10 a.m. hits. The U.S. trading session gains full liquidity, and the floor just, well, it vanished.
Completely vanished.
Silver slid relentlessly. It closed the evening all the way down at $65 an ounce. And, I mean, this isn't just a slight deviation. Silver is basically the shock absorber for the entire precious metals complex.
That's a great way to put it, yeah.
Usually, when macro forces tighten, silver takes the initial impact long before gold feels the structural damage. Like, I always think of them as two exhausted hikers on a really steep mountain.
Okay, I like that.
Like gold is just stubbornly jogging in place at the 4,200 camp, refusing to go down. But silver has just given up and is actively sliding backward down the trail.
Yeah, and silver's dual identity is exactly why it's the one sliding backward first.
The industrial side, you mean?
Right. It serves as both a monetary metal and an industrial commodity.
Right.
So when the macroeconomic environment tightens up, the market immediately starts pricing in an industrial slowdown.
Right.
So silver loses its manufacturing bid. So think solar panels, electronics, EV components, long before gold loses its monetary bid.
Ah, okay.
Yeah, so silver breaking below that $66 level, it's the canary in the coal mine choking on the toxic fumes of a tightening economy. If silver continues to slide and breaks the 65 support, it's a huge signal.
Signaling that the industrial sell-off is accelerating.
Exactly. And at that point, gold's monetary premium just won't be enough to shield it from a broader market correction.
Okay, so if the algorithms are dumping silver out of fear of an industrial slowdown, we have to look at what triggered those sell programs at exactly 10 a.m. I mean, this divergence isn't happening in a vacuum.
No, absolutely not.
And it all leads back to the big three macroeconomic headwinds, right? The Federal Reserve, the U.S. dollar, and Treasury yields.
The trifecta. Yeah, the market has fully digested the reality of a higher for longer Federal Reserve policy. I mean, the forward-looking interest rate swaps, they just haven't budged since the last FAD meeting.
Right.
The institutional consensus right now is that the Fed is prioritizing the complete eradication of inflation over, stimulating short-term economic growth. That hawkish posture is the primary gravitational force pulling everything else down.
And we really need to talk about the velocity of that gravitational pull because the metrics from today are just brutal.
Very.
The DXY, the U.S. dollar index, punched through to 101.07. And at the exact same time, the 10-year U.S. Treasury yield climbed to 4.516%.
Yeah.
For anyone holding physical metal, those two numbers working in tandem, I mean, that's a wrecking ball.
It really is. And the mechanics of the opportunity cost spread explain exactly why the sell-off was so severe. You see, capital managers are mandated to generate a return on their assets. So when the 10-year Treasury offers a 4.516% risk-free yield, the math becomes totally undeniable. If inflation is trending down while nominal yields stay at 4.5%, the real yield, the actual purchasing power you gain, is highly positive.
Right. You're actually making real money.
Exactly. So holding a physical asset like gold or silver means you are actively choosing to forego that guaranteed capital appreciation. And algorithms are programmed to ruthlessly eliminate that opportunity cost. They just move capital out of zero-yield commodities and straight into high-yield bonds.
And then you add the currency effect of a 101 DXY, and the headwind basically doubles.
Oh, absolutely.
Because a stronger dollar actively destroys global demand. If a massive institution in Japan or, say, Europe wants to buy gold, they are purchasing it in a currency that is depreciating against the dollar.
Right, the exchange rate just kills it.
Exactly. The metal itself becomes prohibitively expensive purely based on the exchange rate, which basically shuts off the international bid.
Which perfectly encapsulates that 10 a.m. silver collapse we saw. The U.S. session opened, the dollar strengthened, the yield curve ticked higher, and the algorithmic sell programs just executed their mandate.
Just ruthless.
Yeah. The industrial premium in silver was liquidated to buy U.S. government debt.
But wait, let me push back on that a bit, because that contradicts the old fear trade rule.
Okay, how so?
Well, with the geopolitical landscape being this volatile right now, I mean, specifically the U.S.-Iran talks happening right now in Switzerland, with Pakistan acting as the intermediary, shouldn't the sheer uncertainty have the precious metal skyrocketing as a safe haven?
You'd think so, normally.
Right. Whenever there is tension in the Middle East, capital usually flees into gold to avoid geopolitical risk. Is the fear trade just broken?
It's not broken, but the hierarchy of market drivers has fundamentally shifted. The fear trade you're describing, it relies heavily on the threat of energy-driven inflation.
Oh, because of oil.
Exactly. Historically, Middle East tension threatens the global oil supply. A constrained supply spikes the price of crude, which bleeds into the cost of manufacturing and transportation globally, causing rampant inflation. So gold rallies as a hedge against that specific inflationary threat.
Right, but the data out of Switzerland is actually showing progress.
Precisely. I mean, the negotiations are expected to take 60 days, but markets are forward-looking mechanisms. They don't wait 2 months to react.
Right, they price it in immediately.
They price in the de-escalation today. Because the first round of talks showed progress, the volatility premium in the energy sector just evaporated. Brent crude dropped to $78.70 per barrel, and WTI fell to $74.90.
Wow, so the domino effect there is actually fascinating.
Yeah.
The geopolitical talks succeed in cooling oil prices, and cheaper oil immediately lowers the forward projections for headline inflation.
Exactly.
And when inflation projections drop, the Federal Reserve feels absolutely no pressure to cut interest rates to save the economy.
Nope, none at all.
So we end up right back at a 4.5% Treasury yield, acting as kryptonite to the metals market. The fear trade isn't broken, it is simply being overridden by the rate trade.
That is the exact mechanism. Geopolitics is taking a backseat to monetary policy right now. The algorithms are parsing the yield spread, not the diplomatic headlines.
Okay. So if yields are this high and algorithms are actively reallocating to bonds and the dollar is destroying international demand and the geopolitical fear trade is neutralized, I mean, the institutional money has to be flowing out of gold in massive volumes.
You would certainly assume that.
Right. The price should be cratering well below $4,000. Yet, as we established earlier, it is stubbornly jogging in place at $4,200. Who on earth possesses the capital to absorb all of that selling pressure?
Well, the answer lies in a recent survey released by the World Gold Council and Reuters. And honestly, it exposes a tectonic shift in global finance.
What did they find?
Currently, 93% of the world's central banks hold gold in their reserves.
93%.
Yep. But the really critical metric is that 45% of them are actively planning to increase their physical holdings over the next 12 months.
Wait, really? 45% of the central banking system is aggressively buying an asset that pays zero yield, while their own bond markets are offering historic returns.
That's exactly what they're doing. They're acting as the ultimate liquidity sponge. Look, for the last 20 years, central banks were net sellers.
Right, they leased it out.
They leased their gold out or sold it to buy U.S. dollars. But today, they are draining physical supply from the global vault systems. When a central bank buys, they aren't logging into a brokerage account and buying a paper ETF contract.
Right, they want the real thing.
Exactly. They are taking delivery of physical bars and repatriating them. This permanently shrinks the available float of metal on the open market. So when Western algorithmic trading bots dump paper gold contracts because yields are high, sovereign wealth funds quietly step in and absorb the physical supply.
Wow. So they are essentially setting a hard floor under the market. As the paper price drops, the physical accumulation accelerates, restricting the downside.
Correct.
But, I mean, a floor is just a floor, right? I was reviewing Morgan Stanley's projections for our deep dive today, and they have published a massive $5,200 per ounce target for gold by the second half of 2026.
Right. That's a huge target.
Yeah. I mean, setting a floor at $4,200 is one thing, but driving the price up another $1,000 requires a completely different type of market participant. It's like building a house, right? The central banks are pouring the concrete foundation, keeping the whole thing from collapsing.
I like that analogy.
Right. But to build the roof all the way up to Morgan Stanley's $5,200 penthouse, you need the ETF buyers to bring the bricks. And right now, they are sitting on the sidelines.
They absolutely are. And Morgan Stanley actually included a vital caveat with that 5,200 target. They explicitly stated that reaching those levels is mathematically impossible unless ETF investors, meaning Western retail and institutional funds, start pouring capital back into the market.
Right.
Central banks provide the physical floor by restricting supply, sure, but the paper markets dictate the upward momentum and price discovery.
Because the ETF buyers are the momentum traders. They're the ones who bid up the price in a bull market.
Yeah.
But right now, they are heavily handcuffed to the Federal Reserve.
Fully handcuffed.
That's sitting in 4.5% money market accounts, completely content to just wait on the sidelines. They aren't going to rotate capital back into precious metal ETFs until the FED gives an undeniable, flashing neon signal that rate cuts are imminent.
Exactly. The ETF inflows are the missing engine for a broader rally right now. Until the opportunity cost of holding cash drops significantly, the institutional funds will not allocate the billions required to push gold through those heavy resistance levels. The market is basically trapped.
Trapped between the central banks buying the physical dips and the algorithms selling the paper rips.
You nailed it.
So if ETF buyers are handcuffed to the FED's next move, and the central banks are just quietly accumulating the dips, what does a retail investor actually do in the meantime? How do you navigate a market that is violently chopping sideways while you're just waiting for a macroeconomic trigger?
Well, the entire financial ecosystem is currently holding its breath for the PCE data release later this week. The Personal Consumption Expenditures Index is the exact trigger the market is waiting for.
Wait, let me ask you about that, because the financial media always fixates on the CPI, the Consumer Price Index, when they talk about inflation. Why is the PCE the metric that actually moves the needle for the FED and, by extension, the ETF buyers?
It comes down to how they're calculated. The CPI measures a fixed basket of goods, which makes it somewhat rigid.
Okay.
But the PCE is preferred by the Federal Reserve because it accounts for the substitution effect.
What does that mean exactly?
Well, if the price of beef skyrockets, consumers buy more chicken, right?
Right, obviously.
The PCE tracks those actual shifts in consumer behavior, so it provides a much more accurate reflection of the inflation genuinely impacting the economy. And the algorithmic trading bots are programmed to parse the PCE data, specifically because it directly influences the FED's dot plot.
Ah, okay. Let's game out the scenarios then. If the PCE data comes in hot, showing inflation is still sticky and consumers are continuing to spend despite high prices, what happens?
Well, the algorithms will immediately price in an even longer delay for rate cuts.
So the dollar spikes.
Exactly. The dollar spikes, the 10-year yield jumps closer to 5%, and the ETF buyers remain firmly on the sidelines. Silver likely breaks well below 65, and gold finally tests that central bank floor.
Got it. And conversely, if the PCE comes in significantly cooler than expected,
Then it provides the FED with the exact data point they need to justify a rate cut. The algorithms will front-run the FED, immediately dumping dollars and buying zero-yield assets. The opportunity cost spread narrows, and those missing ETF inflows suddenly flood back into the market.
providing the momentum needed to finally break through that 4,200 resistance.
Exactly.
Well, while we wait for that data, the analysts we reviewed for this deep dive are issuing some severe warnings about capital preservation in a sideways market. The most crucial warning is to stop viewing gold's ability to hold 4,200 as a confirmed rally.
Yes, that is so important.
A market violently chopping between 4170 and 4210 is not a breakout. It is a highly dangerous distribution zone. The fear of missing out FOMO will actively destroy a portfolio in this environment.
Oh, buying into a sideways algorithmic chop is the fastest way to bleed capital. You end up buying the local top and panic selling the local bottom over and over.
Right.
The actionable strategy in this specific environment relies on disciplined capital allocation. Short term, the technical support level to monitor is between 4,150 and 4,170. Resistance is a heavy wall at 4210 to 4230.
And the sources specifically highlight a technical accumulation zone well below current prices. They note that if the PCE data comes in hot and gold, dips down to the 4,050 to 4,100 range, that is the zone to initiate long-term positions.
Yes.
But, I hear this advice from Wall Street constantly. Wait for a confirmed trend before deploying capital. Isn't waiting for confirmation just a sanitized way of telling retail investors to buy late and miss the most profitable part of the move? I mean, if the central banks are building a floor, shouldn't I try to catch the absolute bottom at 40.50?
I get that logic.
Yeah.
And the desire to catch the exact bottom is totally rooted in human psychology. But it is statistically disastrous.
Really?
Yes. In institutional trading, attempting to pick the absolute bottom of a rapid sell-off is known as catching a falling knife.
Right, I've heard that.
A breakdown to 4,050 might look like a floor, but in an algorithmic cascade, support levels can evaporate in milliseconds. Waiting for confirmation isn't about buying late. It is the cost of buying insurance.
Insurance against a false breakout or a continuation of the downtrend.
Exactly. By waiting for the price to establish a higher low and confirm the reversal, you might sacrifice the first 5 or 10% of the upside move, but you ensure you aren't deploying your entire portfolio into a knife-edge drop that continues down another 20%.
That makes a lot of sense.
It's the fundamental difference between aggressive gambling and professional risk management. The strategy for the 4,050 to 4,100 zone is tranche buying.
Right, dollar cost averaging into the volatility. You don't deploy 100% of your capital at one price point, you divide it up.
Precisely.
You buy a third of your position at 4,100. If the algorithms push it lower, you buy the next third at 4,050. It smooths out your entry price and completely neutralizes the psychological panic of seeing a position immediately go into the red.
And you take profits on the way up using the exact same tranche method. You become a manager of risk, rather than trying to be a hero predicting the exact bottom.
Right.
And managing the risk allows you to maintain the necessary long-term perspective. I mean, the institutional consensus remains totally clear here. The multi-year structural bull cycle for precious metals is completely intact.
It's not broken.
No, not at all. The market is currently undergoing a tense, highly necessary consolidation phase to digest a historic 4.5% yield environment and a 101 DXY. If you are holding positions from higher levels, the math suggests viewing them as long-term accumulated assets. Panic selling the bottom of a technically driven, algorithmically amplified dip rarely benefits the retail investor.
It really requires stepping back from the daily chart and looking at the macroeconomic chessboard. And,
Yeah.
that brings us back to the lingering paradox we opened with. The foundation of this entire market right now is the sovereign wealth funds. 45% of the world's central banks are openly, aggressively executing plans to acquire more physical gold over the next 12 months. And they are executing these purchases in the face of a massively strong U.S. dollar. And while U.S. Treasury bonds are paying out guaranteed risk-free yields over 4.5%.
They are willfully trading a guaranteed high-yield return for an inert physical metal that costs money to just store and insure. It completely defies conventional short-term Western financial logic.
Which leaves us with a highly provocative question to end on. What exactly do these central banks, the entities that literally control the global fiat system, know about the long-term future of the U.S. dollar that the retail market is currently ignoring?
That is the big question.
Right. If they are rushing to trade high-yield paper for zero-yield physical metal, they are quietly hedging against a structural breakdown in dollar dominance. The algorithms are focused on the PCE data this Friday, but the central banks are positioning for the next decade.
And understanding that disparity in time horizons is the only way to successfully navigate the volatility we are seeing on the trading floor today. The divergence between gold's resilience and silver's collapse is just the surface tension of a much deeper macroeconomic shift.
The pieces are definitely all on the board. Gold is fighting the algorithms at 4,200, silver is sliding towards 65, and the entire ecosystem is just waiting for the PCE data to trigger the next massive capital rotation. So, we want to know how you are reading the data. Head down to the comments and let us know your projection. Do you think the ETF inflows will return and push gold through the heavy resistance at 4,210, or will the weight of the dollar and the high yields finally overwhelm the central banks and drag the price down to test support at 4,150? Drop your analysis below. Thank you for joining us on this deep dive. Don't forget to subscribe so you catch our next breakdown of the market mechanics, and we will see you next time.